It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, earnings season continues. We're less than halfway through earnings season as of February 1st, but S&P 500 earnings are off to a strong start. Earnings growth through the first 185 of the 500 S&P 500 companies stands at 35.09%, while sales have grown by 18%. Keep in mind, however, that this is somewhat skewed as energy companies have grown sales and earnings at 81.61% and 81,000% respectively as energy companies return to profitability and face easy comps, so we encourage taking the headline number with a grain of salt. That being said, Refinitiv estimates fourth quarter sales growth of 13.4% or 9.4% if you exclude the energy sector, and expects earnings to grow 25.2% or 17.1% excluding energy. We'll be watching sector-level earnings growth as for the first time in what seems like ages, technology stocks aren't expected to lead the way in earnings growth, and in fact, estimates have moved lower for tech. Earnings growth estimates for cyclicals are up 9.5% since September, while earnings estimates for the tech sector are down 1.6%. This trend of lower earnings growth in tech is one that is expected to continue in the coming quarters as well. Should this materialize, it could further power the recent outperformance of value stocks over growth stocks. Number 2, value rotation. For the last 10 years, U.S. growth stocks have outperformed U.S. value stocks by a wide margin. In fact, the outperformance has been nearly 8% per year as growth stocks were powered by the rise of technology stocks, driving these shares to valuations not seen since the tech bubble. This outperformance bucked history as growth has historically never outperformed value to the degree that it has over this past decade. But since late November of 2021, there has been a dramatic shift in sentiment towards these long-favored growth stocks as we sit on the cusp of tighter monetary policy conditions. The tech-heavy NASDAQ peaked on November 19th, and since that time, value stocks, as measured by the iShares S&P 500 Value ETF, have outperformed growth stocks, as measured by the iShares S&P 500 Growth ETF, by nearly 11% as of the January 31st market close. Whether or not this trend continues for a sustained period of time remains to be seen, but as inflation normalizes, we expect it to exceed the Federal Reserve's target. Strong returns in the energy, materials, and financial sectors may suggest that investors are once again ready to pile into these unloved, attractively priced value names. Number 3, geopolitical tensions rise. Geopolitical tensions between Russia and Ukraine continue to rise, and while things aren't yet hot enough to weigh broadly on financial markets, the effects can certainly be seen in the energy market as oil prices reached a 7-year high. Both Brent and U.S. crude closed out January at their highest prices since October of 2014 at $91.70 a barrel and $88.84 a barrel, respectively. Concerns of a Russian invasion of Ukraine aren't expected to ease anytime soon, and if Russia, the number 2 oil producer in the world, does in fact invade Ukraine, it could trigger sanctions from Washington on Russia's energy resources and raise the possibility that Vladimir Putin weaponizes exports of natural gas and crude oil, which would likely send prices soaring. Most defense analysts agree that an invasion is somewhat likely, but still a ways out should it happen. However, they also agree that Russia is willing to go to extreme lengths to achieve its political goals, which could mean even higher energy prices are to come. And that's been your Market Minute for the month of February. Thanks for listening.